From the late 1995 to 2000, the stock market was in exponential rise. It was never as seen before. In fact, at its peak in 2000, the stock market had risen by about 600% from 1995 since its global launch. This happened despite many internet companies lacking profits or even products. Then, on March 10, 2000, at the stock market's all-time high of 5,048.
It's described as nothing short of breathtaking, a points drop never before seen on the US markets. This closing bell might as well have been an alarm, so savage was the sell. It left traders and investors shell-shocked.
Saw it, didn't you? It was down some.
Why? How come?
I don't know.
And spare a thought for Bill Gates. The Wall Street collapse cost the world's richest man a mere $1.8 billion this week alone. It was enough to force the Dow Jones down 616 points, a drop of 5.5%. The fragile technology stocks even harder hit. The Nasdaq index in freefall, down nearly 10%. It lost a quarter of its value in just 1 week.
Analysts always say that gravity always wins, and indeed it had. By 2002, the market had plummeted by almost 80%, leaving investors financially and emotionally devastated. It had erased $5 trillion in market capitalization. This caused a ripple through the market as the internet companies constituted a large portion of the market, causing devastation to the whole economy. This was the burst of the dot-com bubble. Fast forward to 2022, we enter the era of AI and it explodes. ChatGPT hits 100 million downloads in just 2 months, becoming the fastest adopted technological innovation in modern times. Investors are in a frenzy to each get a share of the market. It is referred to as the greatest innovation of the modern times. Huge funding is being poured into data centers and infrastructures to produce chips needed for computing. It becomes a media frenzy. All this leads to exponential growth in the company's valuation. But when we look at the company's revenues, they are not even close to what they are projected to be. Is history repeating itself? Hi, welcome to the Wealth Desk. Let's dive into the alleged AI bubble inflation and see how bad is it. This is going to be really interesting, so grab your popcorn and let's dive into it. The AI market has been on a fast rise since its global launch late 2022. It has risen by about 70% from 2022 to 2025. In fact, NVIDIA, the company that produces chips needed for computing AI, has reached the highest market cap of any other company in the world. At $437 trillion, it has surpassed the entire GDPs of countries like UK and France, which is insane. OpenAI, the company behind ChatGPT, is valued at almost $500 billion. With such kind of valuation, you would expect the company to be making good money, right? Well, OpenAI is expected to close the year with around $9 billion in losses. Not only that, many small AI-oriented companies are reportedly running at very negative margins. So, the big question becomes, then why are the companies' valuations that high? First, let's look at one of the most influential ideas in modern finance and behavioral economics, the theory of reflexivity by George Soros. Markets don't just reflect reality, they shape reality. Don't get shocked by such terms. This simply means that markets don't gravitate to fit the market equilibrium as many people believe, but quite the opposite. The market is influenced by investors who act on imperfect and biased understanding. These investors can push the markets in ways which can make their beliefs temporarily self-fulfilling. It can be represented simply as investors believe a company is going to grow rapidly. They buy the stock of that company and price of the stock rises. This improves the company's ability to borrow, hire, and expand. The company's performance actually improves, and this feeds back into stronger investor belief, which causes even more buying. This continues, and the company's valuation inflates. This feedback drives a bubble, and when the beliefs flip negative, a crash can mirror the same loop in reverse. This is the same case in the AI market. AI is launched, and many say it is one of the greatest inventions in human history. The media is blowing it out of proportion, and many people have a huge fear on missing on the next big thing. And so, many people buy the stocks of this AI companies. AI startups barely making profits are backed up by venture capital firms who invest in them, thinking there is going to be a great breakthrough. This increases the value of these companies. This in turn feeds investor beliefs to buy even more stocks, which increase the values of the companies even more. This inflates the AI bubble. The second thing fueling all this growth is a term you have surely come across, which is circular investments. This graph represents it well. It all starts in the middle, where NVIDIA, the company creating chips for computing power, agrees to invest up to $100 billion to OpenAI. OpenAI in turn sells 27% of its stake to Microsoft. Microsoft then buys NVIDIA chips used for cloud systems powering the AI bots like ChatGPT. OpenAI also buys cloud storage from Oracle, who in turn buy chips from NVIDIA. The Three Stooges clip represents all this really well. It's just like a small town with 5 shops and 5 people who are all buying from each other. Everybody looks like is getting money, but it's just a simple illusion. This skyrockets their valuations as it seems they are making money, even if underlying real value such as real user adoption, product market fit, which means when a product solves a real problem for enough people, and those people are willing to pay for it, and independent innovation are weaker. This inflates the bubble even more. Another problem is investment pledges versus projected revenue. This is how much the company makes versus how much they spend. OpenAI is set to finish the year with $20 billion in revenue, yet are destined to spend around $1.4 trillion in investments for the next 8 years, which is $175 billion per year. They're planning to spend nearly 9 times what they earn, which is insane. Sam Altman, the CEO, was asked that question, and he snapped. I mean, how can a company that doesn't even turn meaningful profit spend such an amount? Big tech firms will also spend around $5 trillion in AI data centers. Revenues needed to make those investments worthwhile are $650 billion, currently at $50 billion. This is the biggest red flag of all market crashes. Companies barely making profits running in huge sums of debt, and investor faith is not something good. Debt should only be used when convinced future is profitable. This is not the case with this AI companies, as the cost of running AI is extremely high. Turning a profit with such expenses is not going to be something easy. I mean, data centers investments outperform all other US investments. This also inflates the bubble more. All this metrics have triggered what many call cracks in the bubble. Big investors are removing their money from the markets. Bill Gates has sold $6 billion worth of his stocks and is now sitting on the biggest pile of money of any investor in the world. Michael Burry, the guy who predicted the 2008 market crash, just put 80% of his portfolio betting against AI. A post by the Financial Times showed that UK pension funds dumped US equities over concerns of the AI bubble. SoftBank sold its entire $5.8 billion stake in Nvidia to fulfill its other AI investment commitments. This can cause what we discussed earlier, the reflexive loop where more investors will also change their beliefs on the AI market, which can cause startling market correction observed with other bubbles. Many people agree that AI is here to stay, but for the short term, uncertainty is the norm. Jeff Bezos said that the AI bubble is more of an industrial bubble than a financial one, as society will benefit in the long term. Mark Zuckerberg and Sam Altman also said that in an interview. Even the CEO of Nvidia, Jensen Huang, said, "Investors worried about a bubble may be overlooking the fundamental technological shift which is already happening." He said things like the end of Moore's law, transistor doubling every 2 years, creating skyrocketing demand for computing power, industries pouring investments into GPUs because traditional CPUs can't handle the cost of AI training, and that AI demand is real as the industry is undergoing structural shifts. All this, he said, Nvidia is the only company capable of powering. To be honest, AI in the future doing many boring tasks kind of sounds good. Many people agree that AI is taking our future jobs and many people are going to be doing what they really love. But for the markets, things are not looking quite promising. If you think, all this won't be affecting me, these are rich people problems, they can deal with it themselves, I want you to think again. More than 40% of the S&P 500 is dominated by only 7 companies. They have even given them a name, which is the Magnificent Seven. This means that if the AI bubble bursts, it will cost a ripple through the market and will surely affect the whole economy. Even the whole world is going to be affected as the US economy takes about 25% of the world's economy. This will cause hard economic times for almost everybody. To summarize all this, AI market value is at very high rates. Yet when we look at the fundamentals, the value is not what it should be. This is what is inflating the AI bubble. I'm not going to say if the bubble will burst or not, but looking at former bubbles, things are eerily similar. Thank you for watching The Wealth Desk. We will be having market analysis every week discussing what is going on in the financial world and be bringing you value. If you have found this video useful and would like to watch more of content like this, like and subscribe.